Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his
Here's the Sandman.
over Sandman.
All good things come to an end, do they? Well, over the last several years, we've all enjoyed one of the lowest tax-friendly environments for quite some time. And that's because of the Trump tax cuts back in 2017. Well, the big, beautiful bill is now law, and several things have gone into place. If you want to take full advantage of what's available to you, then you might want to be looking at doing that now while you have 5 months left this year to do something about it. And, oh, by the way, there's some other end dates coming. So what are they? How do you take advantage of it? What should you do? Well, of course, you're tuned into the right place this morning because that's what we're going to talk about. How are you? What a beautiful day outside. I'm David Hollander, the Sandman. For those of you just joining us for the first time, welcome. You hear the jingle. People call me the Sandman. That's because I answer your most troubled tax, legal, or financial questions each week right here. You've heard about it. The big, beautiful bill. It's now law, and tax changes, they're coming. And it's not a matter of if anymore. It's when and how. And guess what? 25 has some things packed in there, and there's also 26 through 28. So all sorts of little dodging bullets here that you got to know what's going on. Are you someone who could take advantage of it? Are you a lucky one? Well, you'll find out soon as we get into this morning. It's important stuff, and you need to listen carefully if you want to pay less in taxes and keep more in your pocket. That's why you need to keep it tuned right here as we decipher the big, beautiful bill. Are your taxes going up? What could you do about it? With that, let's talk about the big, beautiful bill and what it means to you, because there are some changes and there are some deadlines you need to know. Find out before it's too late for you. You're listening to Sandman on the Protect Your Assets Network. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman around here, and you're listening to Protect Your Assets. And yes, the big, beautiful bill passed is now law. And this legislation preserves some things from the 2017 TCJA Act, but also introduced some new ones as well with some end dates. And so you're probably wondering, well, how does this affect you and what should you be doing about it? That's a great question. And so we're going to get into it this morning. So thank you for tuning in. Well, first of all, one of the biggest news of all is the income tax brackets, all those ones we've enjoyed these past few years, the 10, 12, 22, 24, 32, 35, and 37 are now permanent. So where they were supposed to expire at the end of this year, that is no longer the case. They will now be permanent until Congress does something later, probably. But for now, they're permanent, and they'll be permanent for a while. And so that's good as you're planning your income and how much you're going to be paying on that. Where it gets interesting and where things are changing up is when you get into deductions and estate planning. And so we're going to go through that this morning. So let's start out with some simple things and what they do and what they mean and what you might want to be thinking about. So the first one I'll discuss is what we call the above the line charitable deductions. And this is interesting because if you look at history and how these things have been rolled out and what they mean to people and how people actually use them, you see a pattern. I'll explain. If you look at the COVID time during the pandemic when they had the ability to take deductions, even if you were a non-itemizer, approximately 90 million taxpayers did it. Once the COVID deduction phased out and it went back to the way it used to be for non-itemizers, only 10% of the population used it. So in this new one, what they did is for those folks who like to take charitable deductions, if you look at that or care about it, now you can take the deduction if you're a non-itemizer. What does that mean? Well, beginning in 2026, so not for 25, because some of this does affect 25, but this one doesn't. This starts next year. This is a reinstated deduction which allows you non-itemizers to deduct cash donations to charity of up to $1,000 for single filers and $2,000 for a married couple. So what this provision means is that all households are now eligible to receive a tax deduction for a qualified charitable contribution, period. That's a big difference. So if you have any inclination to do that whatsoever, this should help you. Again, this starts next year, so don't do it this year, okay? Unless you're in the other category. So that's important. What else is out there? Well, this is where it gets interesting. We've got a couple other things to think about. Let's say that you are a high income earner. This new law, if you're charitably minded, will affect you. How? The new legislation caps the tax benefit of your itemized charitable deduction to 35%. In other words, if you're a high income earner and you donate $1,000, you're going to receive a $350 deduction instead of the current $370 deduction. We're just talking $1,000. This goes into effect next year. So if you're sitting here in 25 and you're thinking about making a meaningful gift and you're a high income earner, or you're about to be because you are selling a big position of stock or giving away or selling a company or selling some real estate or anything in that category which puts you up there, then you want to get in front of this now, this year, because it's going to change next year and you're going to lose that. So I would encourage you to start looking at that. How do we do that? Well, we use software. We use planning tools where we can show you if you do this, it means that. If you do this, it means that before you do it. And if you're a financial advisor and your tax person is not doing that for you, then you should make a phone call. To who? To us. 866-PROTECT. That's how you find out. All right. What else? The other big one that I liked a lot has to do with the deductions, standard deductions, particularly for folks who are retiring. Well, beginning with the 2025 tax year, so this is now, the standard deduction increases by another $1,000 for a single person and $2,000 for a married couple filing jointly. So that's nice. This brings your deduction, if you're single, to $15,750, and if you're a joint filer, $31,500. Good. That is also going to be indexed for inflation moving forward. Good. Now, here's where the 65 and older supercharge comes in. We didn't get the Social Security that you probably heard about. No, but you did get this. And if you use it effectively, it could be pretty good. If you're jointly filing, you get $3,200 additionally. Single, $2,000. The senior bonus deduction is another $6,000 per person, up to $12,000 per couple. So now you're talking 43 plus another 32. You could get close to $50,000 of deduction. Now, this bonus only runs through 2028. So essentially, you've got a few years right now to do some things to take advantage of this opportunity, which is there right now for you. If you don't take it, you lose it. It's that simple. Like what? What are some things Some opportunities you should look at if you fall in that category. Well, the first thing you should do is look at Roth conversions. This is where you take your 401k or your IRA or any tax-deferred retirement account and you withdraw that. You pay ordinary income on it. It counts as ordinary income, but if you have these other deductions that might offset that, and you put it in a Roth and you invest it in a Roth, and hopefully over time that grows. And then in the future, when you go to pull that down and tax rates could be higher, you pay less taxes on that income because it's tax-free. So that's a great tool and planning aspect that we do with our software. We look at Roth conversions and how much should you do? Because a lot of people just come in and say, I want to do the whole thing. Let's just go for it, all of it. And well, no, it's not the smart way to go. And you've got some years here to plan, so take advantage of that. Look at it, see what it really means. What else could you do? Well, the other thing you could take a look at is the RMD reduction strategy. What does that mean? Well, we can calculate how much you're going to be taking out in the future in RMDs, meaning when you reach your RMD age in 10 years or 9 years or 15 years, how much will that be? We can show you that number. You may say, well, that's more than I need. I don't need that RMD. Well, guess what? Now's the time to start taking some money out of that in what we call an RMD reduction strategy, where we pull money out now, we pay tax on it, either live on it or roll it into a Roth or do something else with it. So you can do that now. You can lower the RMD in the future by taking advantage of these rules now, at least through 28. What else could you do? I hope you're writing this down. The next one is the capital gain harvesting. This one's interesting. Let's say you're sitting on some big stocks right now. You've had some nice gains in the recent run-up we just talked about here at the opening in the market segment. Well, you could reset the cost basis on that stock. What do I mean? Well, let's say you sell some of that off now. You realize the capital gain, but again, with these deductions, it almost offsets itself. You buy the stock back, and now you've reset your basis in that stock. So this is another strategy you could do now to take advantage of what's out there over the next few years and still be in a stock that you like overall. We call that the reset strategy. It's good stuff, right? There's more coming. When I come back, the big, beautiful bill does something to your estate. This is very important. I've reviewed now in the last couple of weeks a lot of trusts. And in every one that I've seen, it's talked about this. So if you want to know what you can do, you should call us, 866-PROTECT. That's the number. 866-PROTECT. Ask for this. We have a big, beautiful bill checklist. It's fresh. It's big. It's good. It has a checklist in there. Get it. So call us now, 866-PROTECT. Say, give me the big, beautiful checklist, and they'll email it right over to you. I just looked at it this morning. It's pretty good. Anyway, it's there for you. But when we come back, we're going to talk about specifically trusts, big, beautiful bill, and what you need to know. Find out how bad it is. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And of course, you've heard about it. The big, beautiful bill is now law, and there are some changes coming. They are meaningful for most, but you just have to know how to take advantage of them and know that some of them are going to end in 2028. And so you have a window of opportunity now to do something about it. And if you haven't looked at it, highly encourage you to talk to your advisor And if your advisor is just not friendly about it or competent or helping you, well, we've got a checklist you can get that we're more than happy to send over to you to take a look at. It's got some action items that we're talking about this morning that you could look at in the privacy of your own home. Just call 866-PROTECT and ask for the checklist. We're happy to send it your way. Now, another thing, if you would like to get a copy of this show or previous shows where we've talked about things like this, you've got to go check out the podcast wherever you get your podcast. Type in Protect Your Assets and the subject you're looking for, and most likely we've done a show on it. So it'll pop up and you can listen to it at your convenience. And if you like it, share it with a friend. And if you want to go back and listen to anything we've covered today, if you missed any of this segment about the big, beautiful bill and the tax, then go back and listen to this show. It will be posted. So now it's time for one of our fan favorite parts of the show. It's our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so here's one they say. They say that when you leave assets behind to your beneficiaries, for most people that would be your kids, when they inherit your investments like real estate, stocks, they normally don't have to pay a capital gain tax. Is that always true? Now, this is a great question, and because of the big, beautiful bill and the changes that just happened, most of the trusts that I've reviewed recently fall into this trap. So let me walk you through this. Here's how the step up in basis lowers taxes. Johnny's grandmother bought some stocks years ago for $10,000. When she dies, Johnny inherited the stock, which is now worth $100,000. Johnny immediately sells that stock for the $100,000. When Johnny sells a stock or other capital asset, he pays tax on the gain typically, which is the amount you would get when you sold the stock minus the basis. Generally, the amount paid for the stock. In this case, Johnny's gain would be $90,000. So $100,000 less the $10,000 basis is $90,000. However, because Johnny inherited a capital asset, the basis is stepped up. It's increased to the fair market value of the asset on the date of Grandma's death. So in this case, Johnny's basis in the stock jumps from $10,000 to $100,000, which means that he has zero gain when he sold that stock. No tax for Johnny. Nice result. Well, here's where this can change, and here's where I'm seeing a lot of issues right now with trusts. First, most trusts that I read, and yours may be the same, and remember, I'm an attorney, so please talk to an attorney about this who does this. So a lot of trusts out there talk about a bypass. In other words, when one of you dies, if you're married, that person's share must, you'll see the word shall usually in there because that means you must do something, shall transfer that person's interest into an irrevocable trust. It literally gets a tax ID number. It starts filing tax returns every year thereafter. And you get most assets appraised with a basis. Why do you do that? Well, because when the IRS comes knocking later, which they might, you need to prove what the cost basis was in that asset before Johnny, in this case, would inherit it. Now, why is that important? Well, let's say that you've got a piece of real estate, and when Grandma died, or Mom and Dad, one of them died, it was valued at $1 million. And when Johnny receives it through the irrevocable trust, so here's why I'm adding in the layer that a lot of people aren't thinking about. That house gets placed in that irrevocable trust at the $1 million basis because that's the value now. Okay, let's call it $1 million. Well, let's give it a step up. Well, this is what usually happens. They paid $1 million for it, say 10 years ago, the house. Today it's worth $2 million. Someone dies, it's in trust. and now it's $2 million sitting in the irrevocable trust. Johnny's the beneficiary on that trust. So when mom dies in the future and Johnny gets that through the trust, what's his basis? You're right. It's $2 million. So if he sells it for $3 million, now he's got $1 million gain. That's an example of where he didn't get a step up, even though he thought he was going to get it because it was placed in irrevocable. All right. We got a question from Paul from Danville on capital gains. Good morning, Paul.
Good morning. Hi. Thank you for taking the call. What you're talking about is actually very true to something I'm going through right now. My father passed away a couple weeks ago, and the house he lived in was in my grandfather's name. My grandfather is still living, still going strong, but he's already informed me and my brother the house will go to us when he passes. He's okay with us selling it, but since we haven't inherited it technically because he's still around, we're worried about the capital gains. He bought the house like 40 years ago for probably right around $100,000, and it's probably valued closer to $1.5 million now. Is there anything we could do to avoid capital gains if we were to sell now, or is the best advice to wait down the road?
Great question. Thank you, Paul. It's really good. So this is exactly what I was talking about. This is where what we want to find out from Grandpa is when we need to see his trust. So hopefully he has a trust set up where it talks about what happens to that asset at your dad's level, which again, I'm sorry to hear about your dad passing away. And then your level, if you and your brother are the beneficiaries of that asset. So we need to look at that and we need to figure out, well, what is supposed to happen because of this new event you just mentioned, right? That's first. Second is, since your grandpa is around and he has capacity, it sounds like, there are some things we can do. So yes, the answer is you could wait until he were to pass away if that's in his best interest to stay in the house, and then sell it and get a step up in basis. So in other words, get to that 1.5, and then you and your brother could sell it and realize that entire 1.5 essentially tax-free. There's some other issues we got to think about, like Prop 19 and some other things that are out there. But again, this is why you work with an attorney, because if you want a certain result and we can make it happen, we'll make it happen. All right. So what I'd recommend, Paul, is just give us a call, 866-PROTECT. Get a copy of Grandpa's Trust. Let us take a look at it. Give us a call, 866-PROTECT. Okay, so getting back to it, this is common. I mean, this is where I see trust right now. A lot of people have trust, and I congratulate you for doing that. But this new big, beautiful bill changes the end result. You may think you're sitting on something right now that's going to do something, but big, beautiful bill just could have changed that for the worst. Even though it sounds great, there's some good stuff in there. You need to look at it. You need to make some adjustments. Find out right now what you don't know. Call this number and get with an attorney who does this, because that's what we are, as well as financial advisors and tax people. 866-PROTECT. Pick up the phone. Call 866-776-8328. 866-PROTECT what's yours. 866-776-8328. Coming up next, we're going to talk more about this big, beautiful bill and some action items you can do right now before it's too late. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman around here. That's because I help you protect more of what's yours. With all the changes happening, the new big, beautiful bill, it has some great provisions in it, but it also has some time bombs expiring in different years. And if you don't do things exactly right, you're going to lose out. So right now is a great time to take advantage of some of these things that are there I've been talking about. All right, so the big, beautiful bill is now law. And there are some key provisions in there that provide for some pretty nice deductions, particularly if you're 65 or older. But there's a lot of something in there for everyone. And when it gets to estate planning, there is a big one in there. And I was getting at that in the last segment. We were talking about inheriting some real estate and how if you have a bypass trust, you might lose out. You might have made a bad choice, which hopefully you can undo now with what's called portability. The new law has a portability provision where you don't have to elect the irrevocable trust, even though your trust might say so. So you could amend that. In this case, we were talking about Paul and his grandfather. His grandfather has capacity and he had a trust. He could change something where he could make it a Q-tip where you might be able to use that exemption in the future if it works out for your benefit. But if it doesn't, you don't have to do it. So the problem with the irrevocable is once you fund it and it's done, you're stuck. You can't go back. But if you amend it now while you can, you could make an adjustment later that might be to your advantage. So that's a way to take advantage of this new rule, which is now also permanent in terms of the 14.9 million. Next year will be 15 million of exemption per person. What else can you do? Well, you can give away cash or property now. This was another question Paul said. Should we take it now? Sometimes you might. You might want to do that to reduce or even avoid an estate tax when you die. The general rule is that any gift is subject to federal gift tax. However, there's an exception here in 2025. You can give up to $19,000 per person during the year without having to pay any tax. If you're married, you and your spouse can also do another $19,000. So you're talking $38,000 per person. And you can do that year after year after year without paying any gift tax unless the total of all your non-exempt gifts exceed the lifetime limit, which probably won't, depending on your situation, but it's one way to do it. As long as your gifts stay below the annual limit, whatever you give away won't be counted for estate tax purposes when you die. So this is where you might take advantage of this new 15 million next year is what the number is. There's some things you can do now to put some property away where that will pass and there won't be any estate tax on it. So this is what you need to do now when it comes to your trusts and your estate planning. Get it reviewed because most trusts over the last 8 to 10 years have this bypass mandatory irrevocable provision in it, which right now is a problem potentially for you. So look at that. Here's some quick lists to take a look at. Write these down. Have you reviewed your investment portfolio with your advisor to address potential capital gain taxes right now when you know we've got these new exemptions this year and for the next 3 years after that? You need to look at that now. Have you updated your estate plan? I just talked about that to reflect the new exemption levels that are permanent and how they go with your legacy. What does that mean? Have you explored income timing strategies like deferring income or maybe even accelerating deductions right now? Have you revisited your business structure? Are you taking the deductions right now that you should? Are you taking everything you possibly could with your tax advisor? Now's a good time to do that because, again, this new law has some changes to businesses in it. Do you have a clear picture of how tax changes might affect your overall financial strategy, particularly in retirement? If you don't have a roadmap which actually lays all the numbers out so you can see them over the next 20 or 30 years, get it. It exists. It's available. You can do simulations. And that's so much better than just going blind, isn't it? Have you scheduled a planning session with your advisor to coordinate all these areas? So we're different in that we have a tax advisor on staff. We have lawyers on staff who do estate planning. We have financial professionals who do that. And we all sit down around a table and we talk about these things together. I would encourage you to get your team together and talk about these things because you might be missing some holes, some strategies. Your financial advisor is not a tax person. They don't do that. They don't file tax returns. They probably haven't asked you for your tax return in a long time or even looked at it ever. They just make you money, hopefully, which is good. But also, what about the taxes on that? These are very good questions. And so you probably have them and you're probably wondering, well, what can you do about it? Well, you can pick up the phone right now and you can get my retirement checklist. This will get you started. It's absolutely complimentary. Call this number, 866-PROTECT. Even if you're 20 years away from retirement, these habits are good. So get in front of it now. 866-776-8328. Call the number. My team is standing by right now. Dylan, Lucas, Phil, they're answering the phone. Call them. 866-PROTECT. Give me your email and get this complimentary checklist. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer, network manager, Kevin Renfer. And of course, my fabulous producers back there doing all the work, Dylan, Raph, Lucas, Phil. Because without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.